For your money. We're here breaking down. It is a problem when you have what's called fractional reserve banking that every once in a while people get a little scared. Now, you will see articles like this, why SVB's bank failure is really scary. Larry Kotlikoff, a good friend of mine, writes, our financial system is built to fail. Is it about to fail again? The 40-year-old Silicon Valley Bank, our nation's 16th largest bank, just went poof. This is our nation's second largest ever bank failure, but the pundits are saying not to worry. Consider Catherine Rampell of the Washington Post. She says SVB made dumb decisions, and this is nowhere near the scale of the 2008 financial crisis. I would argue it could be bigger. Here's why. Just Google all of the companies above $1 billion in valuation. Many companies are fueled by private equity today on Silicon Valley, and what they did is they pumped up numbers to get large deposits. Now, this is different than the banking industry. Really, this is a Silicon Valley bank that's failing. It's not the old stodgy banks, the JP Morgans, the Wells Fargos, all the bad guys of the '08 crisis. They're well capitalized. Life insurers, very well capitalized. But why I'm concerned about this is not so much the bank failures, but the risk of contagion on the unicorn companies. By the way, they should probably fail. That's what capitalism is based on. But if you Google 2023 unicorns list, I'm going to break down why people should be concerned. So you get these unicorns, and they're founded by somebody, and the company really has no profit. Then Silicon Valley would raise money to get a multiple. So the founder would be somebody, 25, 35. They have a great idea. They got all these rich people to pool their money, and they need deposits in a bank. So that's sort of what happened with the Silicon Valley Bank. But I don't think it's the banking system. I'm more worried about this kind of M&A unicorn list. So if you look at unicorn startups, this is from January 5th, 2023. Wonder how many of these companies will go under. ByteDance, $140 billion company. It's basically Chinese artificial intelligence rivaling Google, TikTok, etc. SpaceX, $127 billion. They're not making anything. Why are they worth $127 billion? Shine, also Chinese, $100 billion. Stripe, U.S. San Francisco-based fintech company, $95 billion. Checkout.com, $40 billion. Canva, $40 billion. How is Canva worth $40 billion by basically giving away free graphics to rival Adobe? Is it really that? Is that rich of a company? Instacart. Oh, I like Instacart. I use it. That's worth $39 billion. I don't know how they make money, Instacart. Databricks, $38 billion. Revolut, $33 billion. FTX was worth $32 billion. So I'm more worried about the wave of these billion-dollar companies that might go kaput, and then people getting freaked out thinking this is a systemic risk. It is a big risk in Silicon Valley. Let me not. If people get freaked out and start pulling their money out of institutions linked to Silicon Valley money, it could create a contagion. Something like we saw in '08. I don't see that yet. What say you? Give us a call. Let's go through more of these companies. A lot of these, by the way, are Chinese-linked companies. Zhao Hongshu, Chinese e-commerce company. Yuanfudao, I don't speak Chinese, so I may be botching these. 15.5 billion. GoPuff, 15 billion. What is it? A marijuana company? No, it's a supply chain logistics and delivery company. So basically, you get a smart kid, has a great $1 billion idea. By the way, these are not $1 billion valuations. Every company, Yongqi Senlin of China, consumer and retail, 15 billion. Ripple, which is suing the SEC, and based upon all of the findings of fact in the court case, they basically lied to all these people, but they may be getting away with it. So Ripple, $15 billion mistake. And if somebody says, well, the G8, they're the money of the G8, biggest scam going. So how many of these crypto-linked banks fail? Silicon Valley banks fail? Personally, you're going to hear, the Bernie Sanders of the world soften their tune, because these are people that largely give to Democratic candidacies. They're based in California, a lot of them, or blue states. OpenSea, based in our New York. New York's a blue state. $13.3 billion to sell little internet tokens that are worthless. If I want an NFT, I'll buy a beach house. A beach house is a better NFT. At least you get some rental income, an Airbnb. It's absurd, folks. Plaid, $13.5 billion. Grammarly, $13 billion. Solanas, $13 billion. Devoted Health, $12.6 billion. Fair, $12.5 billion. Brex, $12.3 billion. Goodleap, $12 billion. Are these companies really worth billions? Or was it all a big charade? Just like in the 2008 with the banking crisis. But I would argue this is a localized crisis to Silicon Valley. That, a lot of these depositor institutions could fail. The FDIC needs to come in this weekend and say no one's going to lose their money. Because here's the thing, once rich people start losing their money, you're then going to see all these laws passed. And you'll see this week that with all the rich people, Boston Private was taken over by Silicon Valley Bank. Bitmain, also Chinese, BioSplice, Juul Labs, if you want to puff with an e-cigarette, $12 billion company to damage your lungs. I picked the wrong line of work, people. I should have been involved in coming up with some weird idea, because I would have been a good founder. I am a founder of this company where we help people with their money, fiduciary planning advice. Zhongmu, auto and transportation. Rippling, San Francisco based internet software, $11 billion. Global Switch, $11 billion. Bolt, $11 billion. Weilong, $10 billion. I mean, this is just ridiculous. KuCoin, worth like $10 billion. These are companies some of you've heard of, most you haven't. Obviously people know TikTok, ByteDance, SpaceX, Stripe, Canva, Instacart, Epic Games, but many of these other ones you've never heard of, and they're probably worthless, and they should go under. But what's going to happen is, because the founders put their money with these banks, people are going to cry. I get it. It could be very risky what's going on in the world, but that's why you should care about legal reserve institutions. And we'll talk about that next. This is Josh Chalinsky, the financial quarterback. Don't touch that dial.
Tune in to the financial quarterback Josh Chalinsky this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Chalinsky Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Chalinsky to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674.
Okay, Clubhouse, this is a live radio show. You can ping in your friends.
988-5674. Or visit
I don't know if Mei Ling is around
That's
and she wants to talk.
JALINSKI.org.
But
maybe it seems like prices can't get much higher. Or that the stock market is headed for bear territory. Or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
There was a comment, they weren't using crypto as collateral. That was more Silvergate. I never said that. Here's what happens. Okay, say you are a crypto founder and you get a $10 billion valuation on your company. The founder might want liquidity. So the founder gets $100 million, let's say, for their shares from a private equity firm. I'm oversimplifying this. That $100 million needs to be held on deposit somewhere because they don't want crypto. They want cash. They want cold, hard U.S. dollars. So the scammer, like, what's his face, SBF, they're holding their cash with a depository institution, i.e. Silicon Valley Bank. The deposits are insured up to $250,000 by the bank. But that banker wants more collateral because they have known loans and things like that. They need to have money kept on deposit. So if you look at the call report, this isn't just made up. There were $1.4 billion in deposits. Just Google SVB call report. And you can see 1.4 billion depositors. The majority of the depositors had 250,000 or more. So where'd that money come from? Money came from generally rich people who don't need a bailout, who shouldn't get the FDIC to bail them out for stupidity, but they will this weekend because our system will protect them, and that's probably a good thing so it doesn't create a run on other banks. And by the way, you can look and see, is my bank lending money to crappy, Silicon Valley-based companies? Now, there have been fear that I heard somebody speak last night and say, well, regional banks, I'm going to short the regional bank ETF. Well, I guess you could, but those regional banks may not have the same exposure of these Silicon Valley banks or the First Republic type banks. And I am worried about a First Republic. I'm worried about a Silicon Valley bank. Now, not to be irresponsible, the FDIC has never done anybody wrong since whenever it was created. So I trust the system. You have to trust the system. Now, this is interesting. Cryptocurrency firm Circle. So again, crypto said it has 3.3 billion of its 40 billion of USD coin reserves at the collapsed lender Silicon Valley Bank. What happens to that money? So you willingly participated in something that was, fake money, not backed by anything. You trusted Circle for reserves. They didn't have the reserves. They had some of it, and they had $3.3 billion exposure. Do they get bailed out? Are we going to bail out a cryptocurrency? Should we bail out a cryptocurrency? I want to hear from you. 800-321-0710. 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds. I think this will be good for Bitcoin because all of these other things will be revealed as sort of scammy alternatives. But, the only stable coin that matters right now is the US dollar, and all of these strange crypto-focused things, could suffer. Will we have a crypto-induced crash? So, yeah, the U.S. dollar is backed by the full faith and credit of the U.S. government. Apparently, Circle is based $3 billion in Silicon Valley Bank. So this will prove a lot of these crypto projects will die in the ash bin of history where they belong. Maybe 90% of the crypto banks, crypto coins, altcoins will go under. And well, they should. But will the government be involved in bailing these people out again? Probably, to some degree. They'll probably come in and say, hey, if you had money on deposit, even though you scammed people when you had them invest in your company, basically, it's funny, this guy's saying the US dollar is dying. No, it isn't. If you think all these crypto founders, why are they crying? When they got paid in USD that they held on deposit at Silicon Valley Bank. And then now they're crying that they're losing their deposits. So this is interesting. According to Larry Kotlikoff, who I love his research, SVB had $175 billion in customer accounts. 85% of these deposits weren't FDIC insured. Recall the FDIC insures checking accounts of up to $250,000, $500K for joint accounts. Hence, had the Fed or Treasury stepped in, they would likely had to insure all of SVB's deposits to keep its large depositors from continuing to run for their money. But that would not likely have stopped the run. A friend of mine had over $20 million in his company's checking account in SVB. Do you think the Fed Treasury Assurance would have kept him from transferring his holdings to, say, Vanguard's money market fund? Hence, had the Fed insured the deposits, they would likely have had to come up with $150 billion on the spot. That's a big number, even by historic standards. So the Fed Treasury blinked as they blinked when Lehman, leaving Lehman's creditors to recover pennies, specifically 41 pennies on the dollar. This is why Secretary Summers' suggestion that everyone with money in SVB will be made whole is wholly absurd. Here's why it's absurd. I want to break this down yet again. If you have, so you're a founder, you got $100 million in deposits with SVB, or $20 million like this guy. Should you be bailed out? I don't think so. Because this is the problem when you give money to companies that don't have a profit, that have no price to earnings ratio. So this whole industry of Silicon Valley is based on its own accounting and future projected gross earnings, not even net income of the company. So you could have these robo-advisors and fintech companies and all of these other companies, they're raising money. They're raising money from rich people. They're holding it on deposit for rich people. Like, I get it. I think the FDIC will make everybody within the 250 or 500 limits whole. But should they really make, spammy altcoin creators or the founder of OpenSea or whoever had their money with Silicon Valley, should they be made whole or should they have kept reserves? Now, they'll probably come in, negotiate some bank buying out SVB to make sure everybody believes in the system. Now, SVB is just one bank, but across the banking system, there are 18 trillion in commercial bank deposits. Of these, only 10 trillion are insured. If I'm one of the depositors with some of the 8 trillion in uninsured deposits, I'm heading for the hills, putting my money out on Monday and putting it in a money market that invests in treasuries. Hence, we could see a massive run on banks by uninsured borrowers, a run that the Fed Treasury has just demonstrated they are unwilling to stop. I don't think they will be. I think there'll be some resolve on Monday. SVB was not a bad bank, financial institution like Bear Stearns, Commonwealth, Lehman, all of which were considered bad because they were run by somewhat unpleasant people who looked and sounded nothing like George Bailey. your favorite It's a Wonderful Life character. In addition to having bad seeming and therefore surely bad people at their helms, these financial companies had highly opaque balance sheets. But SVB was a good bank, according to Larry Kotlikoff. It did what it was supposed to do, invest in mortgages and treasuries. Yet it invested in longer maturity treasuries, and mortgages have long maturities. But that's what banks do. They borrow short and lend long. 2 Nobel Prizes in economics were recently awarded to Doug Diamond and Philip Dybvig for showing how efficient such an arrangement supposedly is. My view, the Diamond-Dybvig model is classic, not because it justifies the current banking system, but rather because it shows the current banking system is built to fail. What's needed is what is called limited purpose banking, a financial sector that can never fail because it comprises 100% equity financed mutual funds and nothing else. By the way, you can do that. You can do that with firms like Fidelity, Vanguard, Schwab, and others. So what say you give us a call now, 800-321-0710 if you have a financial questions. Now, the Dodd-Frank stress tests are a bad joke. SVB surely passed its latest stress test, so it did nothing to stop this. But large uninsured depositors don't care that its bank has even, say, a 10% capital ratio. They will realize after today that banks that pass the Dodd-Frank stress test can collapse. So what do you do? Now, there are many things you could do, but I've always liked legal reserve for my cash deposits. I have always believed in placing money with insurers or like certain money market accounts, FDIC insured up to $250,000. So you mine the FDIC limits. You'd be generally protected if you mine the FDIC limits. Let's say you have 20 million in cash deposits, 30 million in cash deposits. We have programs at Fidelity where you can literally get 30 different FDIC numbers attached to your cash deposits, but nobody does that. Very few. I've told people this, they could do this. I meet with people over the years, they have 2 million in cash, they have 20 million in cash, and they're busy. They're busy at work. And they don't do this. Remember one guy came in a big accounting firm, had 30 million in deposits. I said, you gotta like spread out your banks. We have a program for that. Did he do anything? No. He was too busy running his business. And that's what happens to most of you. You're busy, you're running your business until something like this happens and you freak out. Now realize that the FDIC will not fail because it's backed by the full faith and credit of the U.S. government. You have no reason to doubt the FDIC. And they are probably working now as we speak to come up with a solution so that contagion doesn't spread. But this problem is not limited to just SVB. It's limited to the whole fractional reserve system. Now, in legal reserve, there is a dollar for dollar backing every dollar, like a money market mutual fund or a cash value life insurance policy or a fixed annuity. And you can actually look up, and even if the company goes under, they get into receivership and they have a dollar backing every dollar that's on deposit. That's not how our banking system is. You know, a good bank has a 10% capital ratio, according to the Dodd-Frank stress tests. So what do? You mine the FDIC limits. If you have a lot of cash and you'd rather be lazy and have it with one place, have it with a cash value life insurer. That's mutual. That is dollar for dollar reserves. Have it with a fixed annuity where you know they have the money. Have individual treasuries where you know the government's got your back there. Now, will the government always get people's back? No. Big government can't and won't always save you. That's why if you have a question, call us now, 800-321-0710, and give us a call, 888-988-JOSH during the break if you want a second opinion on your wealth. If you're listening on Clubhouse, You could download the Clubhouse app. You could type in your question. We will bring you up on stage. Or you could call me at 800-321-0710. Call us now, 888-988-JOSH, for the Is My Money Safe in light of the SVB collapse? 888-988-JOSH, 888-988-5674. We'll be back after these messages.
Tune in to the financial quarterback Josh Chilinsky this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Chilinsky Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Chilinsky to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Chilinsky.org. That's JALINSKI.org.
So here's what's going to happen probably. They will probably insure people up to a certain amount. Let's say 2 million, 3 million. That way the small business owner can run their payroll. 90% of these startups will probably fail. This is very similar to the dot-bomb bust. See, history doesn't repeat itself exactly, but it rhymes. Like, what does... Let's be honest here. What does OpenSea actually do? Like, what do? They sell dumb, tokens for money. Like, is that really going to stand the test of time? Solanas, Fair, Brex, Jewel Labs. What's kind of crazy, if you look at a lot of these billion-dollar companies, this is Chinese money. Chi-Com money flowing into Silicon Valley, getting sick valuations from Silicon Valley-based private equity venture capital firms. But I think a lot of these people will be bailed out more than they think. KuCoin, $10 billion. Digital Currency Group, $10 billion. This is from techstartups.com, January 5th lists of unicorn startups. Reddit, $10 billion. I've heard of Reddit. Chihao Duo, Gusto, Service Titan, Oyo Rooms, Niantic, Tanium, Rapid, Kavak. Now, I will tell you, Gemini, $7 billion. Argo AI, $7 billion. A lot of them, over $1 billion. So, something called the Black Unicorn Factory, $6.1 billion. Wiz, $6 billion. Better.com, $6 billion. At least I know what Better.com does. They do mortgages. The Boring Company, $5.7 billion. So here's the thing. Are you concerned about this? Give us a call, 800-321-0710. And then we have George, who thinks he knows better. Go ahead, George. I'm kidding. George.
Morning, Josh.
Good morning.
I have a question about the FDIC insurance on a bank account. They give you a folder at the bank that gives you how it's insured, and I read up on it. And it seems to me that if you have paid on death people on the account, you could be insured up to $1 million per account if you have 4 people on it. So you'd have me as the primary, and then my wife and my 2 daughters would be listed as PODs.
Yeah, there are a lot of ways to get more out of the FDIC for sure. With multiple accounts, you could put $250 in your name, $250 in your wife's name, $250 in, will they count PODs? I believe they do. So that makes sense.
Yeah, so cause I think it's up to one. So if you put $1 million in one account, in a CD, a 2-year CD, just say, I think they will, as long as there's 3 PODs and a primary holder, insure that up to $1 million.
Yeah, personally, I would just spread the 250 with 4 different institutions just to be a little bit more protected, but that's just me. So
Yeah.
And there are some.
Wondered if somebody else knew about that. Maybe they can call in and have something to say also.
You can add POD to your.
After seeing what happened, you can never know.
But you got to realize SVB very different than your normal bank in whose deposits. What people don't realize is, they were a depositor institution, but it's very different than what, your local bank, your credit union.
I come from the old school where I believe in the brick and mortar bank. So that's what when I put my money in the bank, I don't want to go to any of these online type banks, and I do look for brick and mortar.
Well, the online banks are still safe up to 250, but I think the problem with a lot of these companies, they were investing long duration, and those long duration things are not worth anything anymore because no one wants them. So if you bought a 10-year treasury, 2018, 2019, nobody wants them. So they've lost value. But you can actually see the exposure of your bank to this stuff if you go to Call Report. So
I'll take a look.
And
all right, that sounds good.
There's an interesting article. Giannis, the Milwaukee Bucks star, he has money in 50 different bank accounts. So, and the guy on Twitter said, get you an MVP who is familiar with 250K of bank limits. So there's a lot here. So there's a lot here that this is interesting too that I saw. I don't know if this is true. SVB had an insured cash sweep account with a maximum of $125 million FDIC insurance per customer, which would have covered the vast majority of the SMBs, also held off balance sheets, wasn't really advertised to consumers. So you got to get familiar with your money markets, get familiar with the FDIC, get familiar with legal reserve versus fractional reserve. I don't think this is going to induce a panic if it's handled properly. Although, we'll see. COVID wasn't handled properly. I don't know if SVB will be handled properly. Personally, I would have the government come in and I don't know. We'll see. I don't envy the people at the FDIC because they have a tough job this weekend to figure out what are we gonna do to help avoid a risk of contagion. And this is also why you can't just set it and forget it with your money. If you need help, call us 888-988-JOSH for our free review, 888-988-JOSH. We're going to go to the phone lines at 800-321-0710, 800-321-0710. Now, this from Larry Kotlikoff. Financial crises are contagious. Over 80 major U.S. financial institutions failed during the Great Recession. The failures began overseas, came to the U.S., and then spread back overseas. Leveraged banking survives on confidence, and successive failures means further and further loss of confidence. That's why we have Bitcoin now. This is why bank failures happen serially, not simultaneously. The weakest banks fail first, and then the next weakest, and off we go. And failures in one country rattle lenders in another. How should you react? Well, we'll talk about that when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another Great Recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to The Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to The Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check. Tune in to The Financial Quarterback Josh Chilinsky this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Chilinsky Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to The Financial Quarterback and count on Josh Chilinsky to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Chilinsky.org. That's JALINSKI.org.
So the fact that SVB had a concentration of a particular type of depositor, namely venture firms, did not cause its demise. The nature of SVB's depositors' business wasn't the issue. It was SVB's assets, namely their maturity. Any bank that is invested long-term was and remains subject to a run by its uninsured investors, whether they are venture firms or cosmetic companies. It's why I particularly like a fixed annuity or cash value life insurance I like that model better than banking, because now you can see, is my bank exposed to long duration assets? But a lot of banks have short-term T-bill exposure, so they're fairly safe. So, is there risk if a bank held a lot of mortgage-backed securities, long-dated treasuries? So what happens when you have an annuity? Well, if you have a fixed annuity that says, and you put, $20 million in a fixed annuity at 5%, there's a surrender charge. So people aren't going to create a run on an insurance company, generally speaking, because they're going to be penalized because the insurance company is investing long-term, and they add a surrender charge typically if you cancel early on a fixed annuity or cash value life insurance contract. So it is limited liquidity, which allows that financial institution for invest in long haul without worrying about a run. When you give your money to, say, a Fidelity money market or a Schwab money market or a Vanguard money market, you're going to see those things spike in value dramatically. They're generally investing in short-term exposure. Now, I would argue, counter to what Mr. Kolikoff is saying in his article on SVB failures, that I believe it was due to banks giving so much money and assuming a venture capital firm is equal to a dry cleaner or an accounting firm or a financial planning firm. Because of the nature of their depositors, they're not a long-term investor. Like if you have a credit union, generally when you invest in a credit union, they're long-term. I mean, how many credit union failures were there in 2008? I don't have the exact numbers, but I don't think it was many. So give us a call, 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have. One commenter writes, let it fail, no socialism. Next commenter, equity and debt holders should bear the risk of their bad decisions. I completely agree. I don't think it's going to happen, though, because the problem is you're merging private equity, venture capital with deposits. But what if those deposits are like fraudulent? Meaning say you're a Chinese founder of a $10 billion company and you got, $100 million in deposits with this bank. Should you really be bailed out? Just because your private equity firm should go under. Your company should go under because you're an irresponsible owner. But not going to happen. I don't think they're going to let contagion spread. And you also got to realize who gives money to what politician. It's always the case. So you can look up, by the way, the strength of your bank. I don't know if you know this. You can look up on the FFIEC website. So you can obtain a call report of where the money's held, and you just type in your institution. Very interesting. So let's go to some other news, but I want to hear from you. If you have questions on stocks, bonds, annuities, mutual funds, give us a call. 888-988-JOSH. I'd love to meet with you. And do you understand the difference between legal reserve and fractional reserve? Basically, they're institutions where when you have $1 on deposit, they have $1 there. Now, in other news, how much money can buy happiness? I love the idea of convergence. Those rare times when multiple stories about very different issues all seem to land on the same grand truth, albeit from very different perspectives. Yesterday brought just a three-part convergence into focus. It's about money and happiness, which is very much the intersection of where I spend much of my time, behavioral finance and capital markets. Sometimes growing up poor or middle class motivates you to work your butt off, so money is not going to be a limiting factor in your decision-making life. This from Ritholtz.com. Consider 3 issues. Does money make you happier? And if so, why? More specifically, does each dollar you acquire add to your joy? And by how much? Where is your ceiling? Does everyone experience this the same way? Second, who in the world of finance made a boatload of money last year? We have the receipts with names and dollars included. And last, why does the world's richest man seem so miserable? Let's jump right into it. Although, this is funny. I don't know. I saw Jeff Bezos the other day. He didn't look that miserable, but I think the article's talking about Elon Musk. Jeff Bezos, looks like he's enjoying his yacht and everything. This is interesting. The world's richest man, not Bezos, we're talking Musk, is an unhappy person. If anyone needs proof that the law of diminishing returns applies to money also, consider this discussion by Bloomberg colleague Matt Levine discussing the world's richest man and his attempt to find joy. It's not going well. I have to say, nobody makes being a billionaire look less fun than Elon Musk. He is the richest person in the world, or one of them. He decided to buy his favorite toy to make it more closely aligned with his personal tastes. So he did that and it worked. Twitter. Yet it seems that he's miserable every day. Elon seems to have made a series of disastrous decisions, and that may be the source of his unhappiness. His Twitter adventures seem to be hurting Tesla, his primary source of wealth. Maybe that's the issue, or I have no idea. Although I would say Jeff Bezos looks like he's having fun. Warren Buffett looks like he's having fun. So it depends on the person. The Rich List, the 22nd annual Rich List came out yesterday. We're going to talk to you about what it says when we return. This is Josh Jelinski, the financial quarterback. Call us now, 888-988-JOSH, for a review on your cash deposits to make sure you're within the proper FDIC limits. Give us a call, 888-988-JOSH. We'll be back after these messages.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to The Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Chip Chug is saying Bored Ape Yacht Club projects are valued at over 100K. Where do you think this is headed? In the gutter? Thank you. Yes. Yeah, it will be headed in the gutter. All these. Now, I'm not saying crypto is dead. I'm not saying NFTs are dead. I think Bitcoin will kind of swallow them all up. However, it's like buyer beware. It's like the 1920s all over again, except the Bored Ape Yacht Club is, what is it? Nothing. It's a little dumb art project. How are accounts with brokerage accounts insured? Charlie, go ahead.
Good morning, Josh. I was wondering, you were talking about insurance on banks. I was wondering about brokerage accounts, your stocks and bonds and so forth, in a brokerage account. How high is the insurance of those?
Well, stocks and bonds have no insurance. They could go to zero, depending on the company. Now, if you're talking about how safe is like the money market at Fidelity or Vanguard or Schwab, generally they corrected the abuses of '08 when these money market funds broke the buck. So I will talk about that in the next hour. Is that what you mean, like cash in your brokerage account? Is that what you're referring to?
What did you say, Josh?
Are you referring to stocks and bonds within your brokerage account?
Yes, I have a brokerage account, one of the ones you mentioned, and in it, of course, is a money market and stocks and bonds. And I was wondering, I assume they can't take off with my stocks and bonds I hold, but I want to make sure they're insured that, all of a sudden the company disappears. I still have them.
Well, we'll go over that if you call us at 888-988-JOSH. Now, mind you, within Schwab or Fidelity or Vanguard, you have different types of money deposits, different types of money market funds. So you have FDRXX, you have FZDXX, and we're not telling you to go buy and sell these. I largely think this crash with Silicon Valley came as depositors are fleeing certain banks and plopping money in their Fidelity, Schwab, or Vanguard accounts. So I sort of think they're okay from this, but I will go in and read what they say on their websites in the next hour. But I want to be clear here. I don't know where you have your money. I don't know which money market fund you have. So I would come in to get it reviewed at 888-988-JOSH. But generally speaking, when you have a money market fund, let's say at Acme Institution, they will be having short-term T-bills, treasuries, so their exposure to long-dated mortgage-backed securities and 10-year treasuries is very little. Does that make sense? So you're generally more protected in those type of funds. But FDIC, you're protected up to $250. I mean, you got to realize too, your money market fund at XYZ brokerage account is generally not insured by the FDIC. It's that these companies, so you have various levels of protection. So when you're with a brokerage account, you have a lot of cash, you can choose to have your cash with only FDIC insured institutions or their money market. So some choose the money markets for higher yielding cash. So for example, their money markets right now with like 4.46%, but that's not necessarily FDIC insured. So you got to kind of weigh your risks there. But I think a good rule of thumb is to mind the FDIC limits, which are $250,000. And somebody said it'd be nice if stocks were insured. Yeah. By the way, yeah, stocks are never insured. you could lose money in stocks. That's not. But you want to buy quality because my prediction is tech firms may be in for a rough ride this year. So give us a call, 888-988-JOSH, 888-988-JOSH. We'll be back in a few minutes with your calls at 800-321-0710, 800-321-0710, 800-321-0710. SVB shut down sending shockwaves through Silicon Valley as CEOs race to make payroll.
WOR and WAXQ HD2 New York, an iHeart radio station. Available everywhere on our free iHeart
Clubhouse,
radio
we'll be
app.
back on in a few minutes.
Music, radio, and
Share this room with your friends.
National, international. He's on top of the stories that matter to you.
I want everybody to share this room right now.
Bachelor, weeknights from 9 till midnight on 710 WOR, the voice of New York.
An iHeart radio station.
It is 36 degrees at 10 o'clock. Good morning. I'm Paul DeCastro. Cops are investigating after a man was found shot to death in Brooklyn. The body discovered at the Louis Armstrong houses on Lexington Avenue in Bedford-Stuyvesant just after 5:30 this morning. Police say the victim was 46 years old. They have not released his name. No arrests have been made. A man is in stable condition after being shot in the head last night near a park in Queens. Cops are looking for the man who shot the 37-year-old victim around 8 o'clock near Powell's Cove Park in College Point. The suspect fled the scene in an unknown direction. The victim taken to the hospital and remains in stable condition. A man who ran a daycare service from his home in the Bronx is now accused of sexually exploiting one of the kids and recording them in child porn.
Officials say 32-year-old Silfredo Castillo Martinez coerced an 11-year-old at his daycare to act in sexually explicit ways as he recorded on a cell phone and camera. Prosecutors say it happened over a 3-month period in 2018. After his home was raided, officials found those videos as well as nearly 10,000 other child porn images. He's charged with a number of child exploitation and child porn counts. He could face 75 years in prison if convicted. Andrew Whitman, WOR News.
Well, prosecutors in New York are inviting former President Trump to testify before a grand jury. Legal experts say this could be a strong signal that criminal indictments could be coming.
Former President Trump may be closer to finding out if he will face criminal charges in New York over the hush money he paid to porn actress Stormy Daniels. Sources tell ABC News Manhattan District Attorney Alvin Bragg recently informed Trump of his right to testify before the grand jury. The law requires potential criminal defendants be afforded that opportunity, but prosecutors typically only invite targets of investigations to testify if they're moving forward with criminal charges.
And that's correspondent Aaron Katursky. The man convicted of killing California college student Kristen Smart in 1996 will spend at least 25 years in prison. Judge Jennifer O'Keefe called Paul Flores a cancer to society. Smart disappeared in 1996, and Flores was not arrested until 2021. Her body has never been found. In sports, NBA action saw the Nets beat Minnesota in overtime. In the college game, UConn lost to Marquette in the Big East semis. Rutgers fell to Purdue in the Big Ten tournament.
Here's your WOR Weather Channel forecast. Rain will begin to taper off into this afternoon with winds out of the north near 10 to 15 miles per hour and a high hitting 44. Then some breaks in the clouds tonight with a low of 34. So dry weather to wrap up the weekend tomorrow. Expect sunshine at a high of 45. Then the next round of rain develops heading into Monday with a high close to 46. I'm meteorologist Jeff Marr.
Next news at 11. Start your day with Len Berman and Michael Riedel in the morning, 6 till 10 Monday. I'm Paul DeCastro on 710 WOR and NBC News radio station.
Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jelinski. Josh is a noted financial
and if you're on
advisor and
Clubhouse and you
president
want
of
to
the
talk,
Jelinski Advisory Group. And he's here to answer your questions. Call
drop
into
your
the show
question
at
in the chat, and we will
800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jelinski.
We're back. This is Josh Jelinski, the Financial Quarterback, taking your call at 800-321-0710. 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds, the SVB scandal. We're taking your calls right now. Are we live on YouTube? We're live on YouTube or no? We're live on YouTube. So if you want to watch us, you can. Be sure to subscribe on YouTube, Twitter, @YourFinancialQB. We're also live on Clubhouse, iHeartRadio in New York City, WOR. So the 22nd annual Rich List was put out. It is the definitive ranking of the 25 highest earning hedge fund managers. Notice it's not necessarily the most successful for their clients, but based on a combination of fee earnings and gains, the dollars are astounding. The top 25 made $21 billion in 2022, making last year's total the third highest after 2020 and 2021. This works out to an estimated $860 million each. Some of these figures look like lifetime earnings from a prior generation of the top 0.001%. No word if all these dollars made these folks any happier, but I can tell you that from my observations, Steve Cohen is having fun as an owner of the New York Mets. Also interesting to note, I'll tell you about what Rush Limbaugh's widow did with his $150 million Palm Beach estate. By the way, one time we vacationed in Palm Beach for a few months during COVID, during that March 2020, February 2020, and we stayed not too far from Rush Limbaugh's house. It was an amazing estate, sprawling, went for $155 million. His 46-year-old, much younger, much more beautiful wife, Catherine, quickly sold that house, cashed out for the trust that was hers. I wonder why she would have cashed out. Maybe did she only inherit that? Maybe his ex-wives. I think he had a lot of ex-wives. Maybe they had to get paid certain amounts in the trust. I don't know. But that was interesting. That came out in the news a few days ago. Money and happiness. The 4-word question, does money buy happiness, is really asking the wrong thing. Like so much in finance, it requires nuance. Obviously, if you were hungry, lacking basic security, health care, a roof over your head, and other basic needs, you would not be especially happy, at least not in societies we know today. Think about this. If you have 200 grand in the bank, you're happy. You're like, hey, I got the FDIC, I'm safe. If you have 20 million in the bank today, you're a little nervous. So what do? Perhaps a better question is framed as, what is the value of money beyond its basic utility for survival? Where do the laws of diminishing return kick in, like the Elon Musk story? Where is the line where each additional dollar creates little or no increase in happiness or life satisfaction? Bloomberg reports on research that found contentedness does increase steadily in line with incomes and even accelerates as pay raises beyond 100 grand a year, as long as the person enjoys a basic level of happiness to begin with. So basically, if you were an unhappy person before you have money, you'll be unhappy. If you're a happy person before you have money, you'll be happy. So it's, really not about the money. That is only part of the twist revealed by the latest research, however. There's a plateau, but only among the unhappiest 20% of people. And only then when they start earning over 100 grand. This suggests that your outlook and personality are perhaps more determinative of your individual happiness levels than we may have previously believed. The research, which Daniel Kahneman says contradicts a 2010 paper by Kahneman, which found happiness plateaus between 60K and 90K a year. That's because 60K, 90K meant something different 13 years ago. That's why. So money can buy some happiness, but only up to a point of around 500K, unless you're one of those unlucky, unhappy people that peak around 100K. All of which suggests it's nowhere near as clean or simple as we previously imagined. So happiness is based on your spiritual, your emotional makeup, kind of what you do for life? Do you work out regularly? Do you pray? Do you meditate? Do you read? I heard something yesterday. Do you breathe? Do you do breath work? So everybody take a deep breath. You'll be happier. Many Americans claim Social Security benefits at the earliest age possible, but see their monthly benefit checks reduced for life because they did so. Now, a bipartisan group of senators is proposing 2 changes to help encourage retirees to wait. The lawmakers include Republicans Bill Cassidy of Louisiana and Susan Collins of Maine, Democrats Chris Coons of Delaware, and Tim Kaine of Virginia. If the legislation passed, the changes would be included in all the Social Security educational information material, essentially anything the public sees. From CNBC, the proposed updates include changing the language of the Social Security Administration around the claiming process. The earliest age to claim is 62. However, those who claim at that age are seeing a reduction in benefit. Here's the thing. If you claim it early, you should receive a reduction because Social Security is going to be bankrupt in like 10 years or something, or they're going to have to go into the trust fund or whatever it is, but it's not going to be fun. So taxes are going to have to get up or more. So give us a call now, 888-988-JOSH. If you have questions on stocks, bonds, annuities, mutual funds, when to claim Social Security is a critical decision for older Americans planning their retirement. The senators wrote in a letter to the Social Security Administration. Most people, however, do not claim benefits at the age that would maximize their income in retirement, usually because they claim too early. Social Security beneficiaries are entitled to the full benefits once they reach their full age, generally 66 to 67. For every year you delay, you get an 8% increase. Yet 62 is the most frequent age that people are claiming. 35% of men, 40% of women are making that choice, resulting in an average lifetime loss of $111,000 per household. So get this, the wrong Social Security choice could be costing you over $100K. We've been talking about this, by the way, since 2010, when I first started on WR, 08, when I started on WOBM, and people have been coming. I've been meeting thousands of people over the years who have called us at 888-988-JOSH. That's 888-988-5674, 888-988-5674 for the free Social Security claiming discussion, where if you want to know when should I collect Social Security, we will let you know. So give us a call now, 800-321-0710. If you have questions on stocks, bonds, annuities, mutual funds, I'm going to give you some good news in a little bit. But first, we're going to talk about Social Security. But there is good news in the stock market. Very good news. Very good news. But you didn't hear it this week. Did you hear the good news? No. There is extremely good news. I'll tell you about that after the next break. Now, new limit would emphasize maximum benefit age. Some claimants who have the capacity to wait even 6 months to 5 years longer may not be doing so because they don't have adequate information to make an informed choice. So Jim knows this because he's been with me for a while, I hope. The time to collect Social Security is when, Jim?
7-8.
Yes. Beautiful, Jim. Now, Jim's married to a lovely woman. She could take it earlier, because when Jim dies, the wife will get the higher of the two. But if you love your wife or you love your husband and you're the higher earning spouse over the last 30 years, if you wait till 70, you can get like $3,000 a month, $40,000 a year. So, or more, depending. So the idea is the longer you work, the more credits you get. And every year beyond your normal retirement age, you get a 7-8% bonus. But you might say, but I'm going to die early, Josh. No, you're not, because you're going to start taking care of yourself. Stop eating the fried chicken every day. Stop eating the candy in the office. Jim, why do we have candy in the office? I'm banishing. I do not want candy in the office. It's not healthy to our retiree clients. It's causing diabetes. And it's a dumb we started adding kind bars, but let's have more healthier snacks. Okay? Talk to Joanne. Joanne's a health nut. Well, we get that organic blueberries, let's get raspberries and blueberries. Why do we need fruit salad? I don't know. Not fruit salad. Fruit salad's gross because when you have fruit salad, it only lasts for it's only good for a couple hours because then the juices get in and the strawberries start to taste like pineapple. I like when the fruits taste the normal taste of the fruit. So fruit salad's great the first 20 minutes it's made. But after a while, it's But yeah, I guess if you really want to have a fruit salad, that's better than noshing on chocolate. I don't know why we have all this junk. The candy is banished. Okay, we're done. Could buy gum or something. No, you won't buy it. Yeah, well, I don't know who's buying it. No. I don't know they're gifts. No, but we have the jars of candy that you get from Costco or BJ's. Oh, yeah, banish them, Jim. It's over. You could put some little gum out, assorted packs of gum. But we're done with the candy. I want to encourage longevity in my clients and our staff. But anyway, so people are thinking, you know what, I'm going to die earlier, so I'm going to take it earlier. It's not a good reason because you might still live to your 84. I mean, my dad thought he was going to die at 50. He lived till he was 71. If he just would have taken care of himself from 50 to 71, he was eating Breyer's vanilla ice cream every night, eating these dumb packs of apple pies from the dollar store. I mean, if he didn't do that for 10, 20 years after his first cardiac event, he probably could have lived till he was 80, 84. So, lay off the sugar, people. So anyway, enough about that. I'm not giving health or medical advice in any way, shape, or form. But the point is, people should take Social Security later in life, and new language would emphasize that it's a maximum benefit age. Mailed benefit statements would be more frequent. Lawmakers would also propose having every person with a Social Security number receive a Social Security statement in the mail regularly throughout their earnings history. They used to do that every year. You'd get a Social Security statement that would show you the benefit of waiting. Now it's online. Do we really need to, as a government, spend money for postage? Just go to ssa.gov, download your Social Security statement. This is a dumb plan, but I guess people lack education. Next up, Ron has a question. Should he sell his stocks and put his money in a savings account? We'll talk to Ron when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Tune in to the financial quarterback Josh Jelinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the financial quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the financial quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Okay, we're back. This is Josh Jelinski, the financial quarterback. Give us a call, 888-988-JOSH, for the free "What do I do with my money in light of the SBV failure review?" It reminds me of the underwear BVDs, SVB. That's a tip. Don't put your money with a bank that rhymes with an underwear. Go ahead, Ron.
Yes, how are you, sir?
Great. Go ahead.
Hello? Hello?
Yes, what question do you have?
Well, my question is, I have about 700,000 in the stock market. I am pretty much financially sound, but it keeps going down. I was well over 900. I lost a lot. My question is, should I take some of the money out and put it into a savings account? I'm an old timer, and I'm just worried about it keeps going down.
Do you need the money within the next 5 to 10 years? Or is it rainy day money for your kids or whatever?
Then yeah, darn it.
Okay, number one, Ron, is if you have money in the stock market, you should not plan on touching it for 10 years. So you could be okay if you have good quality holdings. But I would make sure you have less tech exposure, you're more diversified in varying asset classes, and you're following modern portfolio theory. Markowitz, French Fama, which is diversification in different asset classes. You're not heavily exposed to more than one company. Generally, could we lose? I've been saying for a while, I think the market could go down another 10, 20%. But I will tell you the good news. We did not break 3,800 this week. You would have thought with this major bank failure, now watch Monday be really bad. But we have not broken the lows of October. We've not broken the lows of June. And we've not experienced that level of fear. The question is, does this cause a contagion? First Republic Bank really was rocked last week. Now, we had Barry Dyke. I'd love to have him on. Might have him on tomorrow if I can get him on. Or next week. Talking about the ripple effect and the bad banks. Now, by the way, a lot of these banks are going to say, well, we were good banks. A bank should not have money in long-dated treasuries. Those are for insurance companies, not for banks. And because when you have an insurance company, they invest for the long term. When you buy a 1-year CD, that's short term. Rates are higher. Now, that's also why you got to diversify banks. You may want to diversify stocks. I would not go out and sell all of your stocks. I mean, this is, I guess, why the market was reeling this week. You have people who generally get freaked out and they start to sell everything. So Tiger has a question. Tiger says this: what happens if a bank goes under and individuals need to collect FDIC? By the way, the reason the FDIC takes over a bank right away is there is actual money at the bank. So I don't know if you know this, there's money. I looked up the call report for SVB. They had $149 billion. I don't know if this is a typo, in money markets. So those money markets are short term. They're not mortgage-backed securities. So people could probably be made whole very quickly on a large number of their deposits. But what was happening was everybody in Boston private credit. I heard the lines in Boston of all the rich people in Boston. They were pulling their money out. So I don't know. You live in Boston, Jennifer. Was that happening? Right? Are you Jennifer's in Boston? Are you in Massachusetts right now?
Right. That's right.
Was that happening? I heard it was crazy.
Yeah. I mean, like I said earlier, there are a number of industries in this area that are severely affected because much of the venture capital money is actually coming through SVB. I don't want to say all of it, but certainly a good portion of the life science sector that's here in the Boston area, they use SVB. So it's definitely worrisome, but not just here in Boston. It also affects company life sciences in San Diego and San Francisco and everywhere in between. So.
Yeah, it's sad what's happening. My laughter before was more nervous laughter, but I'm
Write
not,
it out, and
I'm not making light of anything. Okay, we got Ron. Ron is still there. Go ahead, Ron.
Yes, sir.
Go
yes,
ahead.
Sir.
You're standing by. What other questions you have?
Well, that's all. I just I'm getting nervous because it keeps going down and down. And so the basic, I should pretty much write it out. And,
No. You shouldn't write it out if you have crappy funds or stocks. I don't know, but if you have quality companies with low debt, the problem with these Silicon Valley companies and the life sciences companies, no disrespect, Jennifer, because
right.
I know you work for them,
right.
is they don't operate under normal accounting. They raise money because they generally have to pay people like Jennifer good salaries to keep them. The IT, data people, life sciences, science people, they want good salaries. So the private equity company will give money, let's say $100 million raise. The founder will usually pocket $10 million from that $100 million. Then they will use another $10 million to hire people. That'd be nice, Jim, right? And then they try to bring the $100 million to $1 billion, and they sell the company. But it's not like the company's earning money. They're just on raises. So I went with, one time I was romanced by some private equity company. They were like, oh, well, and it was like, it's strange. It's like funny money. So I operate under old school principles. If you don't have a wide cash moat, you don't hire people, you don't pay a certain amount, but it's tough in this competitive labor climate. So a lot of these companies operate under strange economic principles where they don't have to earn money. Does that make sense?
Yes,
because
sir.
they're going to actually, cure sickle cell anemia. They're going to cure, COVID. I mean, if you think of like Moderna's profitable company now, but for years it wasn't. Think about Amazon, right? For years it wasn't profitable. Now it is. So it's sort of the Amazon model where you take cash and you just grow in hopes that you'll either go public and the public markets will give you your liquidity. So you can make sure you have good old fashioned companies with wide cash moats that will survive this. Now, will they go down in value? Sure. But like Sherwin-Williams is still going to produce paint. Costco is still going to be around. Walmart's going to still be around. Amazon's going to still be around. Google's going to still be around. So, and when you have fear, and I'm not recommending you buy or sell those companies. I own some of them for clients myself. But the point is, in this tech space, biotech, life sciences, all of these high growth industries, AI, fintech, they're generally some founder, some silver-tongued founder encourages people to give him money because they think they believe in him. I should have done this 10 years ago. And then they cash out and they enjoy the finer things. Meanwhile, people are wondering where their payroll is. I've heard that the FDIC will come in and protect the payroll. The FDIC, by the way, there was a question, what happens? They've already taken over the bank, so they stop the runs on the bank. There is money in Silicon Valley Bank. I mean, I looked up the call report. They had $149 billion with a B in money markets. Now, how much of that is deposits for private equity firms? So personally, if I was in charge of the FDIC, now I don't theoretically agree with this crony capitalism, I would probably insure all of the depositors cash, but I would let the private equity funds and the venture capital funds fail. But it's tough to distinguish because if, Johnny Founder has $3 million in a bank account to make payroll for 1 year, people don't realize that, it takes $1 million to run payroll for even a small company. So, they could have $20 million in a payroll cash account. Those will probably be insured. So we will see a lot on Monday. If I was President Joe Biden, I would talk about this first thing Monday. But I don't know. But, well, we'll see. Next up, we have Sandra, who is a widow. Oh, I'm heartbroken. Go ahead, Sandra.
Yes. Hi, Josh. Nice speaking with you. Yes, I just recently lost my husband December 29th. And it's very hard. But anyway, I went to file for Social Security to find out exactly what I would be getting. And this is what they told me. They told me that I would not be getting the amount of my husband's Social Security. What they do is they would subtract my Social Security from his. I would keep my Social Security and then get the remainder of what his would be, subtracting from mine.
Yeah, but it should equal.
I just heard.
It should equal
I'm sorry?
all of. Yeah, they do that. That's the spousal benefit. Let's say he was making $30,000. Do you know how much he was making a year?
Okay. He had his own business. Do I know exactly how much he was making? He was making pretty good money. He was. I never really was involved in the exact amount. He always worked with his accountant.
Sure.
There's a lot of things that I didn't know, but
well, you got to know, and you can't just trust the accountant, because I know many widows, they've been screwed by the family accountant or lawyer. You have to become educated financially yourself. That would be my first tip.
I wasn't.
And it's horrible to go through this. It's horrible to go through this because you're trying to grieve. And now you have to be a little bit of a financial genius too.
Yes.
Number one, we've helped many people in your boat get educated. Mm-hmm. So number one, you got to be educated. How to run a budget, how to work Social Security, how to create an income plan for yourself. It can seem overwhelming, but it's really simple. And we found
he took over everything. He paid all the bills. The only thing I paid was I had 2 credit cards that I took care of personally. I was a former teacher. Mm. My husband was a milkman. He had his own business. So now it's me. Now I'm doing all of this, and it's overwhelming.
Well,
to say the least.
Don't go it alone.
I'm grieving for my husband that I've been married to for 57 years.
Wow.
Met him when I was 15 years old, high school kids, and so he's all I knew.
Yeah.
He's all I knew. And I miss him dearly. And now I've got to assume this. But I wanted to just call about the Social Security. I got to get my finances in order. I've got to do something. I do have a substantial amount in a money market that I should maybe get someone to advise me on how to make that money grow a little bit more.
Yeah, and we'd love to help you. 888-988-JOSH. And I'll personally meet with you or any of our people dealing with this. Dealing with the loss is very hard. We actually have a book for people losing a spouse. We had a guest on. I did a show, I don't know. I want to say, what was it, like a year ago? On what do you do the first year after the loss of a spouse? And I'll give that book to you. 888-988-JOSH really will help you. Also, it's just basics. It's very simple. Your husband may have been a financial genius, and it may be complicated. Sometimes men in particular, they have like 20 accounts with 20 different people, and they have all these things going on. And what I found is actually sometimes the old school male-female distinctions, roles, hurts particularly women when they lose their spouse. So we will help you kind of get a sense of your money. Call us at 888-988-JOSH. Now, on the question of Social Security, Very easy. I will answer that when we return. If you can hold through the break, I will give you the Social Security answer. This is Josh Jelinski, the financial quarterback. Don't touch that dial.
Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jelinski, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Question from Jerry. Does the California bank have enough to cover assets to cover the uninsured deposits? I'll talk about that more next, and how to figure out if your bank is a solid bank by looking at the call reports. But first, beloved Sandra, recent widow, here's the thing. You don't get your... So if your husband was making 30 grand... See, this thing, you got to know the basics. What was he earning on Social Security? What are you earning? If let's say he was earning 30 grand, Sandra, and you were earning 15 a year, you would get 15 grand from yours and 15 of his to equal his whole benefit. So you're getting your checks plus a spousal. So it should equal, all of yours should equal, when you add in the spousal, what he was getting. And, but you will lose, in a sense, you get his, but you lose yours. Now, they tell you you're getting yours plus what's called the spousal benefit. But if he was making 30 grand a year and you were making 15, you don't make 45. When he passes, you would make 30. Does that make sense?
Yes. Okay. That was basically what, after subtracting mine from his, that basically did seem to average out to his, maybe $10, $15 less. But when I heard you say that we would be getting the initial amount that my husband was making, I said, I've got to call up Josh and let him know what they told me.
Yeah, what you should be getting equal to his whole benefit. So it shouldn't be $15 off. But it sounds like what they're telling you isn't incorrect. But we've heard a lot of people over the years, particularly people who lose their spouse, will end up getting bad advice from the Social Security Department. Because they're generally...
Then how do you find out the actual advice if we're getting bad advice? How do you know? Like people like me that really don't know very much.
Well, you have to get his work record. You go to SSA.gov. You register for him. You get the credits for him from SSA. And then you bring it to us, and we have a software to make sure you're getting the right amount you're supposed to. But generally speaking, it sounds like if you're within $15, it doesn't sound like you're getting screwed too much.
Yeah,
but I don't know why it's $15 off.
Okay, because I just figured it out, and I would be getting about $100 less. I know it doesn't sound like a lot.
Yeah, I don't know why you're getting $100 less. That doesn't sound right. It really doesn't. So I would call us. We could help you. It might take a few meetings to figure out what's going on. But that's okay. And you should be, people should be patient with you if they want to work with you, because it might take 5 to 7 meetings for you to get your financial affairs in orders. And that's okay. We don't mind meeting.
Get this straightened out.
We don't mind meeting as many meetings as you need. And if we're not a good fit, we'll steer you to people who would be. Okay?
Thank you. Thank you so much, Josh. Thank you for taking my call.
No problem. My heart goes out for you. And we've had Larry Kotlikoff on the show, who has lambasted Social Security over the years because people with your boat, I don't know why they're giving you $100 less a month. That makes no sense. You should be getting 100% of his. Now, it is called spousal. So your Essentially, if you were getting 15 grand, your spousal should be 15 grand. Now, maybe you're getting penalized because you took it earlier. I don't know when you took Social Security. To make sure you do it right.
Social Security when I was 65.
Yeah, that might be why, actually. But we'll look into that.
Oh.
But I don't. You get if you want to know the exact perfect amount you should be getting, you get his work record from the Social Security office. You get your work record, and you bring that in, and we test it on our software.
So I will make an appointment because you have to make an appointment now with Social Security, and then I can ask them for my work record, my husband's work record.
Yeah, and then maybe they'll explain the difference, but I would still bring the work record to our consultation at 888-988-JOSH because we don't always get the full truth from them. Over the years, I've heard these reports from Professor Kotlikoff where you could Google articles, Social Security screws widows and widowers, and it's out there. Bad information being given, and it's horrible to deal with that at this time. I don't think the person you're dealing with is trying to screw you. Does that make sense? They're trying to do the best they can. But I'd want to know for sure, why are you not getting that extra $100 a month, right? You paid into it your whole life.
Yeah.
Now, it could be as simple as, they're penalizing you because you were supposed to take it at 66 and you took it at 65, and that might be why. I don't know what your full retirement age was.
He started collecting Social Security at 65 as well.
Yeah, that may actually be the reason of the $100 a month difference. But I won't know until I see the work record. It sounds about right, but just double check your numbers. That's all I'm saying. And the way to double check your numbers is to get your work record and his. You're entitled to that when you go to SSA. Now, you can also, if you have a child or if you're good with the internet, go to ssa.gov. You can register his. You may be able to register his. You may not. And you can get your work record online. So have somebody help you with that. Okay. And then we could.
SSA.com.
SSA.gov. G-O-V. For Social Security Administration.gov.
Okay, got it.
And also an alert for all people. Make sure you have multi-factor authentication on all of your accounts. We've been hearing an abundance of scammers try to hack into people's financial accounts. So that's another thing, making sure your accounts are protected from. Okay, so lovely to talk with you, Sandra, and I'll look forward to meeting you, 888-988-JOSH. Next up, we have Pat. Go ahead. Go ahead, Pat. She says, today is not the same 250K as in 2008 when the FDIC increased it from 100K. Do you think there's a possibility they'll increase it in the next couple of years or not in these precarious times? If I were the FDIC, I would immediately increase it to $500,000 and protect up to $500,000 in deposits. I think that would ensure there's less of a run on various banks. So thank God for the FDIC. It's been a good institution. It's one of the good things over the last few years, but in a way, it's given people a false sense of security with some of these banks. So give us a call, 888-988-JOSH. We'll be back after these messages.
Tune in to the financial quarterback Josh Chalinsky this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Chalinsky Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Chalinsky to call the play. For a free copy of Josh's book, The Retirement Reality Check, Call 888-988-5674. That's 888-988-5674. Or visit Jalinsky.org. That's JALINSKI.org. Maybe it seems like prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinsky, the financial quarterback, can help you protect your family's financial future in times like these. Tune in this weekend to the Financial Quarterback to hear how Josh and his team can help you decrease your tax liability and lower your risk. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Tune in every weekend to the Financial Quarterback and call 888-988-5674 to receive your free copy of Retirement Reality Check.
Okay, we're back taking your calls at 800-321-0710 if you have questions on stocks, bonds, annuities, mutual funds, the Silicon Valley Bank problem. We're here. I will tell you, though, the financial news media love this fear and greed cycle. Just a month ago, they were saying, the market's back, baby, plow it in. Now they're saying, pull all your money. Here's the thing. This is why a financial plan is important. You have your emergency fund, 6 months to a year of expenses in the bank. If you don't have that, don't invest. You need a year's worth of living expenses that is non-tethered to the market. If you're a senior, I would say you need 1 to 10 years of expenses in things like annuities that will give a guaranteed income based upon the claims paying ability of an underlying insurance company, which doesn't have the fractional reserve problems that banks have. And also have cash stash. So if you have, let's say, 1 to 3 years of expenses in cash, 3 to 10 years in immediate term assets like cash value and insurance, fixed annuities, your market money should be your 10-year money, even if you're a senior or retiree. So like if you have $1 million and you have 200 grand in conservative stuff or 500 grand in conservative stuff, and you have 500 grand in the market, who cares if it goes down 50%? I mean, you're going to care, but as long as you have good quality earnings, you shouldn't be freaked out. These things happen about every 7 to 10 years, according to these cycles, guys. Talked to somebody yesterday, the 41-month cycle, the 48-month cycle, the 84-month cycle. Everybody changes their months, based on the news of the day. And, is there a crash around the corner? I don't know. Nobody knows. But I do know that financial news media thrives on the fear-greed cycle. And you, as a financial consumer, shouldn't be an idiot. You shouldn't sell everything because the market's down. And you shouldn't buy everything because the market's up either. You should have a well-reasoned plan. Avoid consumer credit card debt like the plague. Have good mortgage debt, 30-year fixed mortgages. No 5-year adjustable rate mortgages. No ARMs. No, if you can't afford a house with a 30-year mortgage, don't buy the house. I mean, it's very duh. Have insurance to protect your loved ones if you die early, equal to the amount of years you plan on working. 10 times your pay if you're 50 and older, 20 times your pay if you're under 50. Have life insurance. Make sure you don't have a GoFundMe page when you die. Oh, poor, I don't know. Poor Sam. I was going to, name some nondescript. You know what? For some reason, everyone is always Bob or Jim. Have you noticed that, Jim? So poor Sam. Sam left his wife penniless. We're going to take a collection or a love offering at church for his wife. Or now the old love offering has been replaced by a GoFundMe page. How do you know people aren't absconding with the money on the GoFundMe pages? I don't trust them. I really don't. I'd rather a love offering at church because then I can ask the church treasurer, was the money deposited Oh, Sam, did you get that money? Yep, I got that. I don't trust. I've heard so much GoFundMe scams. I don't trust it at all. But generally, GoFundMe has sort of replaced the love offering at church. Isn't it funny how you can, we live in a more of a less religious society today, but there is still the spirituality and religion in everyone's heart. So they're trying to crave something that is a good and orderly thing. You know, the original life insurance companies were all created by churches. Like the Lutherans had their life insurance company. The Catholics had theirs. The Presbyterians had theirs. And the idea was that they would pool their money so widows and orphans wouldn't be penniless. So today, the modern equivalent is a GoFundMe page. But a 40 grand, the highest GoFundMe page I ever saw for a widow was like 50 grand. That is not going to take care of somebody. Will for a year, but after that year, the money's run out. The child is still fatherless or motherless. They need an income. So life insurance should be a cultural value. So basically, I'm the financial quarterback, so think of blocking and tackling. When people get freaked out about the stock market, which seems like it happens twice a year, right? I don't know if that's the cycle. It's the twice a year freak out cycle. You know, there was one in October. It seems to happen every 4 to 6 months. Now it's March. What is that? 5 months. So we're in the middle of it. Then there'll be a freak out cycle in September, October. There'll be another one next up. So people love to get freaked out. I wonder if it coincides with the financial news media. The financial news is saying, oh, the money's going under. They don't tell you they have 149 billion. I don't know if this is true or not. I read this on the Call Report, which is the government backed thing. So those 149 billion should pay off a large majority of the people who have their money with SVB. So you should be okay. So give us a call, 888-988-JOSH. We would love to meet with you. 800-321-0710. So for a society, I am really zealous for these private equity companies to go under. Here's why. They don't have earnings. Let's look at some companies. Would you like that? So you as an investor back in the day would go to your Wall Street Journal. Now you can go to Yahoo Finance, although I've read a report that Morningstar is way better than Yahoo Finance. So let's look up, I don't know, some weird company. Let's look up, and I'm not recommending you buy or sell, but Con Ed, right? So you put your money in Con Ed stock. It's $90 a share. It lost, what did it lose? $1 yesterday. Big whoop, right? You lost, it was big to you. They earn $4.66 per share. They have a price to earnings ratio of 19.45. Forward dividend of 3.55%. I'm not telling you to buy this stock. What I'm using is there are companies that have earnings, right? They have yields. And 19 times earnings is a little rich, but it's a value. Let's name one of these dumb stocks that, and I'm not saying it's a bad stock, but it's instrumental. Datadog, okay? Symbol DDOG. I'm not telling you to buy it. I'm just using this as an example. $65 a share. They don't have a price to earnings ratio. They don't have earnings at any multiple. They're not 100 times earnings. They don't even register because their earnings per share is negative 0.14. But for some reason, it has a target estimate of $102. So people are relying on future growth. Your grandma would not have invested in that type of stock. But Wall Street is filled with that. But it's really not Wall Street like the '08 crisis. This is Silicon Valley money. This is different. And you could look at so many other companies like that are overvalued by normal accounting practices. And will they go down? Maybe. So we're going to have to go back to old school investing. That's what your grandma did. Grandpa, he bought Disney stock. He didn't buy, Datadog. But I'm not telling you Datadog's bad or buy and sell anything. I'm just using that as an example of we will look at every stock you hold and see, okay, are there earnings? Are they going to be resilient in a recession? Call us 888-988-JOSH for the free What Do I Do in a Recession review. 888-988-JOSH. We would love to meet with you. We talked about a lot. We talked about SVB. We talked about Datadog. And we'll talk about more when I return for our parting thoughts. This is Josh Jelinski, the financial quarterback. Call us now.
Tune in to the financial quarterback Josh Jelinski this weekend and learn how to protect your financial future in a down economy. Josh and his team at the Jelinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the financial quarterback and count on Josh Jelinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674. Or visit Jelinski.org. That's JALINSKI.org.
So this is a pretty cool program that we offer through Fidelity. If you are worried about cash at the bank, there is something called the FDIC Insured Deposit Sweep Program, where cash balances in the FDIC Insured Deposit Sweep Program are swept into an FDIC insured interest-bearing account at one or more program banks, and under certain circumstances, deposits swept into program banks are eligible for FDIC insurance. Now, that's not all money markets at Fidelity, not all money markets in your brokerage account, but you can get a cash management account and you can just call us, 888-988-JOSH, and ask us, is your cash in your brokerage account safe? So the way the program works is there is a money market mutual fund overflow component, and there's a lot there. So the interesting thing, though, is a lot of people are moving into the less insured. So there are different symbols where they give you a higher interest rate, but they're not necessarily insured. Same institution. So with Fidelity, you can have FZ, SXX, FD, RXX, ZDXX, and they pay different rates. And so you just have to mind your cash management program at your brokerage account. So if you have Fidelity, Vanguard, Schwab, any brokerage account, we could help and evaluate whether you have that. Give us a call, 888-988-JOSH. We'll get through this, folks. We always do. We got through June. We got through October. We'll get through March, and we'll be here for you. If you want to call us, 888-988-JOSH. We'll meet with you, 888-988-5674. This is Josh Jelinski, the financial quarterback. I'd love to meet with you. Shake your hand. Call us for the 27-point ultimate financial game plan, 888-988-JOSH.
The preceding program was sponsored by the Jelinski Advisory Group. Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Wealth Quarterback website at Jelinsky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinsky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning